Okay, let's get started. Thank you for joining. Good morning, good afternoon. On behalf of everyone here at SCS Global Services and SCS Consulting Services, I'd like to welcome you to today's webinar. My name is Karen Righthand, and I am the Vice President of Corporate Marketing here at SCS Global Services. And I will be joined today by Bonnie Holman, the Managing Director of ESG Consulting at our SCS Consulting Services division. And she will introduce herself here in a minute. Before we get started, just a few housekeeping details. Everyone has been admitted to the webinar platform in listen-only mode, and that's to cut down on any background noise. But you can still engage with us, the speakers. To do that, if you'd like to ask a question at any point in time during the webinar, you will see a question section on your control panel in the webinar. And you just open that up and type in your question and press send. And we will be kind of monitoring the questions as they come in. And with time, time allowed at the end, we will take as many questions as we can and answer them. And if we have to, we can take some of those questions offline and answer them that way. So the other thing that I want to cover right away is that today's presentation is being recorded, and the slides and the recording will be sent out after the webinar to both attendees and those that registered were unable to attend. So I'm excited to get going. Let's jump right in. So I do just want to say just a couple things about SCS Global Services. We are a 40-year-old sustainability certification auditing standards development body. We've worked in 125 countries and have done tens of thousands of certifications in more than 120 programs. We've got over 15,000 clients. We've been around now approaching 40 years, and we have auditors in every market. We have evolved. SCS Global Services is the core company, but there have been several satellite companies developed. Notably, we have a standalone standards development body, SCS Standards. And Bonnie is representing today from our, fairly recently formed SCS Consulting Services division. And then we are an emerging climate registry to tackle specific climate mitigation projects, and we'll be creating a marketplace there. So with that, I'd like to introduce my co-speaker, Bonnie Holman. Bonnie, take it away.
Great, thank you, Karen. My name is Bonnie Holman, Managing Director of ESG Consulting at SCS Consulting Services. I bring a decade of combined experience at SCS, partnering with companies on their sustainability journey, and 2 of those years is at SCS Consulting and roughly 9 years prior on the SCS Global side. So SCS Consulting Services was launched in 2021 as a dedicated sustainability consulting business to operate alongside SCS Global Services, as Karen mentioned. We essentially do a sustainability advisory, which cannot be done at an audit body such as SCS Global. Grown out of SCS's collective deep experience and impact-driven market solutions, our aim is really just to serve as a partner for our clients throughout their sustainability journey. And we do that by supporting them to create and achieve their sustainability goals in a rapidly changing climate and business environment. This slide provides a summary of our core services, a main category of which is climate services, which we will be covering California's newest climate disclosure laws today. So the webinar topics that we're going to cover today, we're going to give an overview of the 3 laws, and we're going to dive into the specifics of the 3, SB 261, SB 253, and AB 1305. We'll talk about what's in them, who they apply to. We're going to cover some key regulatory dates that you're going to want to keep track of, the assurance requirements that are related to all 3, And then we'll end with some specific action steps for preparedness. So just an overview of the 3 laws. Importantly, all 3 were signed barely a month ago on August 7th, 2023. And they all are related to climate, but have specific focuses to the regulations. So SB 261 is the Climate-Related Financial Risk Act, and that's really focusing on a company's assessment of their climate financial risks to their company, and those are along both physical risk, transition risk, and then the mitigation efforts that are taken to address those. SB 253, the Climate Corporate Data Accountability Act, is really focusing on greenhouse gas accounting and reporting. And that's going to be encompassing scope 1 and 2, which are direct operational emissions, and scope 3, which are emissions associated with supply chain or value chain. AB 1305, the Voluntary Carbon Market Disclosures Act, really focuses on transparent information and public communication around carbon offset disclosures and claims around carbon neutrality and net zero.
Actually, Bonnie, those were signed on October 7th, not August.
Oh, I'm sorry. I meant to say October. Thank you, Karen.
The ink isn't even dry. Yeah.
That's right. Barely. Thank you for that clarification. SB 261. So this is the Climate Risk Act, and this is applying to companies doing business in California, which have gross revenues exceeding 500 million annually. The law is going to be applying to both public and private companies, and the law really focuses on companies preparing and publishing a report biannually that discloses their climate-related financial risk and opportunities. The SB 261 language specifically cites using either the Task Force of Climate Financial Related Disclosure Framework, otherwise known as TCFD framework, and or the International Sustainability Standards Board newly released standards that are known as IFRS, S1, and S2. You might be asking why a different acronym. IFRS stands for International Financial Reporting Standards Foundation, and they are the foundation that oversees the newly formed International Sustainability Standards Board, otherwise known as ISSB. Lots of acronyms here today. And this standard was specifically created to establish a global baseline of sustainability reporting, with the focus being initially in 2 standards. 1, general requirements around sustainability reporting, and S2, which is really the focus of the SB 261 regulation and focuses on climate financial risk disclosures.
So Bonnie, I just wanted to jump in here a little bit. The regulation states it applies to companies doing business in California. Is there a specific threshold for that requirement, or how is that defined more specifically?
Right. There's a couple of things to keep in mind for doing business in California, and exactly which companies, this regulation applies to. It's important to note that the regulation specifies that the California Air Resources Board, otherwise known as CARB, another acronym today that we will be using, will establish specific rules on what doing business in California means. But at this point in time, the best functional definition that we have is really just looking at the California Tax Board, which defines doing business in California already. And by the way, that's quite a low threshold. So for companies that are not necessarily domiciled in California, but that do business in California in any way, the definition may include things such as engaging in a transaction for the purpose of financial gain, which is specified in the tax board's definition, And it can also include payroll compensation or property ownership as low as just under $70,000. So again, the threshold is quite low. So for companies looking at whether the regulation applies to them, they'll want to focus on their annual revenue. And then there's another important consideration here. So the regulation does define covered entity. So covered entity means a corporation, a partnership, limited liability company, or other business entity that is formed under the laws of the state of California, the laws of any other state in the US, or the District of Columbia, or under an act of Congress. So with this covered entities definition, we can at this point in time assume that this law will apply only to US-based companies, but again, we'll be waiting on CARB to set specific regulations around that.
Got it. And how is the $500 million threshold applied? Like, is that business revenue only generated from doing business in California, or how is that defined?
Yeah, that's another great element to understand about this law. So the 500 million revenue annually is going to be determined at the corporate level. And so again, this will apply for any company that meets the doing business in California definition. But in terms of revenue, it's the entire business, has nothing to do with any revenue specifically earned from the state market. One thing to also note about SB 261 is that it is applying to both public and private companies. And it's estimated that among 10,000 companies with over 500 million in annual revenue will be required to report under 261. And then what is quite interesting is out of that number of 10,000 companies, only 20% are public. So SB 261 is really bringing into the fold a large number of private companies who might not have actually been tracking to the SEC's proposed climate rule that addresses climate financial risk reporting. So I want to just get a little bit into kind of what those reporting requirements are. So I mentioned that the regulation is specific to require companies to report to either TCFD, which is a voluntary framework comprised of 11 recommendations that are organized under these 4 pillars that you kind of see on the screen here: governance, strategy, risk management, metrics, and targets. The IFRS standard is really taking those core TCFD recommendations and encompassing them into a global recognized sustainability reporting standard. So what it does is it kind of goes further and really transitions voluntary recommendations into requirements. And as you all know, when you're talking about regulations, requirements are what matters. On this slide, I want to break out just the specific details, the specific reporting requirements that you will see under the 4 pillars, and then these are specific to the IFRS S2 standards as well. For companies that are familiar with TCFD, it's probably worth understanding some of the differences between TCFD and IFRS S2, and also understanding, if you are going to be reporting to this regulation, what are the specific details that you'll be required to report. So governance and risk management in terms of reporting pillars are largely unchanged between TCFD and IFRS S2. But within strategy and metrics and targets, we do see some specific changes. Under strategy, you'll see that in bold. So really asking companies to report in a required manner the current and anticipated effects of climate risk and opportunities on the business model, the value chain, on the company's strategy, the company's decision making, as well as climate transition plans. In metrics and targets, there's just specific metrics that have been added or moved from voluntary to sort of mandatory reporting under the standard. And I say that in the context of the regulatory oversight. So those specifically are the amount and the percentage of assets or business activities with vulnerability to physical and transition risk, as well as remuneration around executive pay, specifically linked to management of climate issues. When we talk about physical and transition risk, it might be worth just breaking those two down and understanding briefly what they entail. So a physical risk is going to be a physical risk of a company's assets, operations, things like that. You can imagine damage to a building, things of that sort. Transitional risk is looking at the risk of a company's transition to essentially a climate scenario of the future, and that's done looking at a number of different climate scenarios that have been established under the IPCC, and really assessing from a financial risk perspective, you know, what that means for the company to transition to a decarbonized or a future warming scenario. So we want to understand a little bit from the participants on the call today, just where they're at in assessing their climate-related financial risk. So we'll give about 30 seconds or so for folks to answer the poll, and then we'll kind of move on from there. So just as those numbers are coming in, it's really interesting to see, you know, the large majority of everybody on the call has not gotten started yet. And that's really helpful for us to understand. I do know that SB 261 does seem quite daunting, particularly because it's process oriented. The initial reporting comes in 2026, which you know, is actually a little bit around the corner, because that report needs to be published by January 1st, 2026. What I will say about SB 261 is that whether it's TCFD that you're referencing as a document, or the IFRS standard, both of those you'll find include starting a process that will then become more specific to the organization over time. And so there are different ways to get started with it. I think we can go ahead and close the poll. It looks like we've got 60% not yet gotten started. 11% have published a TCFD report. 3% only have carried out climate scenario analysis. 15% climate risk assessment, and 10% have implemented some recommendations. So climate scenario analysis, just by way of example, would be something that, you know, you might not do the first round in reporting if you haven't done anything in the past. It is, of course, in the TCFD framework and in the IFRS standard, but again, the standard is written in a way that ask companies to take a stepwise approach. And in the coming year, we will get more specific guidance from CARB on reporting requirements. However, specifically with SB 261, especially seeing the polling results, I would say, you know, certainly getting a plan in place to start the process, you know, is important and should occur in 2024. So now we're going to move on to SB 253. So SB 253 is similar to SB 261 in that it applies to companies doing business in California, but it does have a higher total revenue threshold than SB 261, and that is 100 billion annual. So in summary, for companies with
1 billion.
Oh, I'm sorry, I meant to say 1 billion. Thank you, Karen, for catching
You're
me
welcome.
on my oral typos here.
I'm learning as I go as well.
Yeah, so 1 billion. What that essentially means is if 253 applies to you as a company, so does 261. Like SB 261, the regulation applies to specific partnerships, corporations, limited liability companies, and other business entities, which is a little vague and will be further defined by CARB. What we discussed in terms of, doing business in California for SB 261, it's a little bit of the same waiting game to understand that for 253. But again, I would take that expectation of there being quite a low threshold for that definition. It is estimated that SB 253 will affect roughly 5,400 companies. So it's about roughly half of SB 261. And then, of course, the focus of the law is really around reporting of a company's greenhouse gas emissions. The reporting for Scope 1 and 2 direct operational emissions will begin first in 2026. And then the reporting for Scope 3, those value chain or supply chain emissions, will start in 2027.
And Bonnie, the proposed SEC ruling requires annual GHG reporting. So how does SB 253 compare to the proposed rule that the SEC is proposing? And what do companies need to know to prepare for both?
Yeah. So really specific to SB 253 from just a perspective of methodology and what companies need to do kind of behind the curtain to calculate and prepare. SB 253 cites reporting according to the GHG protocol standards, both the corporate standard and the Scope 3 value chain standard. And by the way, these kind of methodology-based references that are both in the SEC rule that is proposed and expected at any time is the same as what we find as well in new regulation in Europe. So the data process for SB 253 and reporting emissions for a company that falls under SB 253 compliance is really going to be the same process behind the curtain. There are a couple of elements of SB 253 that are different from the proposed SEC climate rule. And so I can go into those. And what I should really say about it is when you look at SB 253 and SB 261 that we just talked about combined, you do get similar topics of reporting with the proposed SEC rule. The major difference is that the SEC rule is only applying to public companies right. on US stock exchange. The California regulations encompass both private and public companies, and so really there's just a group of private companies out there that probably we're not tracking to the SEC proposed rule that now will need to kind of get up to speed with some of their public competitors that might have been preparing for the SEC proposed rule for over a year now. Maybe the other distinction to note is just around Scope 3. So SB 253 is specific to require Scope 3 reporting starting in 2027. And at least in the past year, there's been quite a lot of musings around Scope 3 potentially being taken out of the SEC rule, and we'll just have to wait to see about that. It is estimated that of the roughly 5,500 companies that are going to fall under California's SB 253, that there's 1,500 companies that represent the public companies that will report to both SB 253 and the SEC rule. Maybe one other thing to note about SB 253 is just like SB 261, both will fall under CARB's purview. And in 2026, CARB will be publishing, no later than January 1st, 2025, CARB will be publishing regulation around the reporting process, and they will be engaging with an organization within the state to help kind of provide guidance and set the reporting process.
Great.
Great, so let's move on to AB 1305. So AB 1305 is going to be applying to two basic groups. So we're going to start off with the first one here on this slide, but the groups are either, and both is what I should say, marketing or selling entities of voluntary carbon offsets within California, which we'll get into in a second what that means, or purchasers or users of offsets in California. So what it specifically says is that a business entity that is marketing or selling carbon offsets within the state shall disclose on the company's internet website a very specific list of information related to the carbon offset projects and the specific offsets that are generated, traded, and retired through the project's lifetime. When we say marketing, what this basically means is any company that's marketing to anyone that may be purchasing or using carbon offsets within California. So this is a very broad net, and we can really view this essentially as encompassing any U.S.-based entity that's marketing or selling carbon offsets at this point in time without further guidance, just because of the way marketing works. The details of the carbon offset projects that need to be transparently communicated on a company's website include specific information around a project. Some of this information will look familiar to folks operating in this space, but it's going to include the specific protocol used to estimate emission reductions or removal benefits, location, project timeline, the date that the project started or will start, and then the dates and quantities of when specific quantity of emission reductions or removals have started or will start. It's also including dates that emissions might have been modified or reversed. It includes as well reporting on the type of offsets, whether they are emission reductions or removals, and really breaking down annual reporting requirements across each of those offset types. And then there's reporting requirements around the durability period, particularly if the project lifespan is presumed to be less than the atmospheric lifetime of the GHG emissions. And then additionally reporting on third-party validation and verification status of project attributes. So in addition to those project details, the disclosure requirements also focus on accountability measures around risks of reversals, risk of permanence, that sort of thing, and then pertinent and specific data and the calculation methods needed to verify quantities. So the information is quite comprehensive and it is quite specific as well. So the second group of companies that AB 1305 applies to are companies that are purchasing or using voluntary carbon offsets and operate in California or purchase or use carbon credits within California. This part of AB 1305 also extends to companies with claims of achieving net zero or carbon neutral. And that's both at the company level and the product level. So the information that needs to be disclosed on a company's website for this group of companies around offsets, it will include, the seller, the register program, the specific project name and ID, the offset type, the protocol used for reductions or removals, and information around third-party verification of data and claims. So you can see that that list, looks very similar to what we just talked about as the required list for marketers and sellers. Around net zero and carbon neutral claims, the regulation asks companies to transparently report how the claim was determined to be accurate, what interim progress to goal, how those measurements were done. So if it's a net zero target, for example, said to have been achieved in 2023 from a 2020 baseline, asking for, how that progress was made over that target period. And also asking for information on whether independent third-party verification was used. So we've just talked about 3 laws. Your brain might be spinning just on all of the information contained in them. What I want to do is just really go over some of the really important regulatory dates to keep in mind, particularly as you're navigating whether any of these regulations might apply to your company, or if you know that they do and you're wondering what you need to do and by when. So AB 1305 is really the regulation that has the most urgency around it in terms of reporting, and that is because it was passed on October 7th, 1 month ago, but it becomes effective on January 1st, 2024. I think that we will all expect to receive more specific information from the state of California on enforcement and implementation. However, there's very limited time for companies to kind of pull the data together just to prepare for this being regulated. So certainly get started on that right away. 2024 in general will be a year of preparation across all 3 of these regulations. And by January 1st, 2025, we will know specifically from CARB the exact reporting regulations, the exact process timelines, and things like that for SB 253. Also for SB 253, important timelines to look at are going to be reporting to scope 1 and 2 in 2026, and that date, that specific deadline date in 2026 will be set by CARB. By the way, it's not just reporting in 2026, it's reporting and doing so at a limited level of assurance, which Karen will talk about shortly. 2027 will include scope 3 reporting and then annual reporting thereafter. And then by July 1st of that year, CARB is tasked to publish their first report on company performance to SB 253. And for companies who are wondering why do they need to report their emissions to California, what is the overall intent or the goal of the state, the regulation does specify that the report needs to include information around reporting entities and their relation to California's climate goals at minimum. And then let's look at 2030. So 2030 is important for 2 reasons. It is when scope 1 and 2 annual reporting needs to graduate from a limited level of assurance to a reasonable level of assurance. And it's also when scope 3 needs to be reported to an assurance level, which would be the limited level of assurance. So for SB 261, as noted earlier, the report needs to be publicly published, and there will also be a reporting process directly to CARB, and that will occur by and no later than January 1st, 2026. And then the regulation requires biannual reporting thereafter. So for companies that get that report done just under that deadline, their biannual timeline will fall in 2028. Maybe one thing to note, just when looking at these timelines, when Governor Newsom signed both of these laws, he did so with comment, and his comment did make reference to the deadlines, being quite short for companies, and he also made reference to some concern around scope 3 and duplicating reporting. So we do think that there will be much more figured out around scope 3 before 2027. And finally, he gave a nod to the financial impact to business and has tasked CARB to closely monitor, regulation development with view to cost to companies. So we mentioned assurance, and I want to just kind of give a summary of what those assurance requirements are with respect to each of these California regulations. So let's start with SB 253. It's the easiest one to look at. So assurance is part of all emission reporting under SB 253, and essentially has requirements of each scope 1 and 2 and scope 3 starting at the limited level. And for scope 1 and 2, there's requirements to graduate to reasonable. The regulation at this time does not set a date for scope 3 to graduate to reasonable, and instead the regulation states that the state board will review and evaluate trends in third-party assurance requirements for scope 3 emissions. So we can expect more to be developed around this topic in the coming years. For SB 261, the regulation is specific around the GHG emissions that kind of fall into the TCFD or IFRS requirements. And those are really around emissions calculating and reporting. And so the regulation actually really includes essentially an overlap of the assurance processes that we just talked about for SB 253. And just so companies are really clear on what that assurance requirement is, it specifically states, to the extent a climate-related financial risk report contains a description of a covered entity's greenhouse gases or voluntary mitigation of those gases, CARB may consider a covered entity's claims if those claims are verified by third-party independent verifier. So because climate transition plans are contained within 261, and it will inevitably entail emissions reporting within that, it's just worth companies to understand that assurance kind of finds its way into 261 just through the GHG scope 1, 2, and 3 reporting and assurance processes. So for AB 1305, we went over just the information that companies need to put on their websites, and that largely includes the status of validation and verification of offset projects. And so it's not really asking companies to carry out that new process, but really to report transparently on that status. For the part of AB 1305 that does reference carbon neutral claims as well as net zero achievement, if these claims are not currently backed up through third-party verification, it would be smart for companies to look at that and take a step now towards that, just so that required published information can stand up to scrutiny. And then maybe one thing to note specifically around the net zero claims. So that's the science-based targets net zero standard. And while the regulation is very specific around third-party verification, the process to date for under the Science-Based Target Initiative is that science-based targets, including net zero targets, are directly validated by the Science-Based Target Initiative, and so they're not third-party verified. So there's just a little bit of a technical distinction in the language of the regulation that's not correct to the current process. So that might get clarified over time. I'm going to pass it over to you, Karen. We've mentioned assurance, and so people might be wondering what that means. So I'm going to hand it over to you to talk more.
Yeah, and the reason we're kind of shifting gears here is that obviously on the consulting side, they can't do the assurance. So I'm here to represent sort of the verification arm of the SCS business and talk more about greenhouse gas verification, which we've been doing for over 15 years. So before I jump into this limited versus reasonable, I just want to go through some general things about assurance. And the California bills have some very specific language. I'm actually going to have to read it because it's very wordy, but it will give you an idea of the intent. And it reads that a third-party assurance provider shall have significant experience in measuring, analyzing, reporting, or attesting to the emission of greenhouse gases and sufficient competence and capabilities necessary to perform engagements in accordance with professional standards and applicable legal and regulatory requirements. And it goes on a little bit. You can tell just from that they want companies to choose verifiers that are science-based, familiar with the ISO standards, familiar with the greenhouse gas protocol, and that can, carry out a very rigorous assurance on the greenhouse gas emissions. I mean, the whole point is that we're trying to get to the truth with your greenhouse gas inventory. So I just want to say just a few things about the verification. I mean, some of you on the call may have already created a greenhouse gas inventory. Maybe you've only done scopes 1 and 2. Maybe you've done scopes 1, 2, and the relevant scope 3 categories for your company. Maybe you've already gone through an assurance process. Companies are in very different places on all of these issues, but certainly for private companies, this may be a lot of new information. So why do you need verification? Well, inherently, your greenhouse gas inventory is a very complex system. It's the integration of accounting and engineering and science. So they tend to be multi-layered systems with various people interacting with those systems, various technology platforms. Some may have their energy bills coming in and being, handled by some software. Others may be input by employees. Often the inventories cross over into various departments, regions for global companies, and even third-party consultants sometimes are the ones preparing the inventories. And they interface with one or more data systems, and there's the possibility for mistakes and for storing and transforming your data, maybe correctly, maybe not. So they're very dynamic systems and they evolve over time. They need to account for organizational changes such as mergers, acquisitions, divestitures. They can include changes to methodologies, changes to what we call emission factors. So it's very important because your stakeholders are only seeing the full outcome of your inventory. They're not seeing any of the back, the back calculation. So the assurance process can be very helpful to you in giving you confidence that your inventory is correct and that the numbers are spot on. And it can also help you build confidence with your stakeholders that, that your inventory is, completely buttoned up. So the standards, and as does the SEC ruling, mention different levels of assurance. And you have a limited level of assurance and a reasonable level of assurance. And the main difference becomes the level of rigor and the audit time allowed to dig in on the project. So for limited level, it's less evidence, assumes that some elements of the system are reliable, whereas for reasonable, it's that we dig into more of the primary data. For both, the conclusion follows a 5%, plus or minus 5% materiality threshold. So we're looking to see if there are any errors, if they constitute more, plus or minus more than 5% of the material inventory. So that's the threshold that we measure to. And this, of course, is very well determined and spelled out in the greenhouse gas protocol and the ISO standard that we follow for the verification. Let's take a look at the map of a typical, it's a kind of a skinny down version of a verification map. On the screen, you see a simple representation. Your inventory will likely be much more complex. And this shows sort of the, you have your inventory at the top, you have your calculations and aggregations, you have your primary data tracking, and you have your primary data records. So, starting at the bottom, the invoices come in, they get rolled up, they get calculated, they get, rolled up to the assertion at the top. And all along the way, you can see on the right-hand column, and we're not going to go into these in detail, but you can see some of the possible errors that can occur. And part of the job of the verifier is to get in and look at each of these levels and see, do the assertions make sense? Do the numbers add up? Were the right units used? Were the right conversion factors used? And ultimately get to that below 5% threshold so that we can give a positive verification. So that's just a little bit about, about verification. I do want to say that SCS Global Services has had a verification practice for over 15 years. And CARB is going to make the ultimate decision on who really can do this according to that guidance that I read you at the very beginning. SCS Global Services has been verifying inventories for companies that are reporting to CARB under their MRR, their mandatory reporting requirements. So we've been recognized by CARB as a verifier. We are accredited as a verifier for that program. And I expect that those are the types of organizations that you're going to want to reach out to. SCS, again, we have over 15 years doing inventory verification at both limited and reasonable levels. Most companies start with limited, as does the guidance in these California bills recommend, as does the SEC recommendation, but generally they move through time to a more rigorous assurance in the reasonable level. So definitely want to look at lining up a verifier for in the future when you have an inventory so that you can see where the errors might be and get it all buttoned up so you can build confidence in your reporting. So Bonnie, I think send it back to you. Oh, we have a little poll. So let's see. Yeah, let's see who's done assurance or, just kind of curious. And maybe you don't even have an inventory to assure. So it'd be good to know, where people are.
Great. And once again, we're kind of seeing a trend here. It looks like over 53% have not engaged in an assurance process. 16% have not yet calculated emissions, and then 10% in the process now. And those numbers are shifting, but those are kind of the trending figures.
Great. And I just want to remind people too, please type any questions that have come up for you into the question panel.
Yeah, and it looks like we've got quite a number here. So let's go ahead and close this poll, and we'll move over to a preparation checklist and then get to these questions before we are out of time. All right, thank you. So this is a slide. We're going to leave this up, and folks can kind of, they'll
I don't
receive.
see it, Bonnie. Can you share it? I don't see the slide.
Oh, let's see. I think it needs to move back from the poll to the presentation, perhaps. Let's see. Are you seeing the slides at all, Karen?
Not yet. Not yet.
Okay.
Sorry about that, folks.
There we go. How about now?
No. Yes. Great.
Okay, wonderful. Great. So this checklist, we created it such that folks on the call can refer to this later. And it's really just a punch list of things that you can do with relation to each of the laws. So just looking at the time, we've got about 10 minutes left and quite a number of questions. So I want to jump actually into some of the questions and let people kind of look at this checklist as we answer questions today. I see one that's really an easy one to answer right off the bat. It says, did you mention reporting is to be biannual under this regulation? So there's different reporting requirements with regard to the three different regulations, but the biannual report is related to 261, and that's the climate financial risk report. The GHG inventory reporting is annual.
Right.
Let's see, it looks like there's another one here that I see. Is there a common definition of material misstatement? I believe you talked about that threshold for reasonable and for limited. Do you want to go over that, Karen?
Yeah, it has to do with looking at the whole inventory and making sure that your calculations and your rolled up inventory is correct within 5%. So if you found a small error and it affected 1% of the inventory, so say it was 1,000 tons of GHG emissions and it affected 1 ton, that would not be material and it probably wouldn't need to be addressed. So we're just trying to get to a 95% confidence level that the inventory you're reporting is correct.
Great, thank you. Wow, so many amazing questions coming in. These are great. I'm gonna see, I've got some of them flagged here that I know we want to cover that are important. Okay, does the public disclosure of offset project details within AB 1305 also include the public disclosure of renewable energy certificates? So AB 1305, as we noted, applies to two different groups, sellers and marketers of offset projects, as well as users and purchasers of offsets. And then it also includes companies with claims at the product or the company level around net zero or carbon neutral. As the person who has this question might be aware, renewable energy certificates are allowed as part of that matching process. So it's actually not an offset, but a matching process in that reporting. And so the requirements around AB 1305 that state that a company needs to report, how they achieved net zero or how they achieved carbon neutral. If the purchase of RECs was part of that how, then they would be, then that would be part of the public information that would be shared.
One thing I just wanted to bring up in relationship to that, Bonnie, is for a product carbon neutral claim, I think, it would behoove anyone making a claim like that to have to report both the verified carbon footprint of the product that the claim is, based on, and the having so a verified inventory against which you've purchased credits, and then showcasing the retirement of those credits. So I think that's the intent of the law, is that carbon neutral claims are robust, and that they're based on solid climate mitigation projects for clearly defined removal of certain tons of CO2, and that those are then tied back, retired, so that they can't be double counted and they're linked to your product carbon neutral claim.
Great. We have so many amazing questions coming in. I will be able to stay on a little bit longer to answer some of these. They're just so good, and this is such timely regulation. I want to be able to stay on and get some of these questions answered. So I just want to mention that, because I know we've got quite a large number of participants still on the webinar. There's a question here: do these regulations apply to private universities? So under the covered entities regulation around businesses, corporations, it does say other business entities, but to date we have tended to see government institution, public institutions such as universities, nonprofits excluded from quite a number of the regulatory requirements that are coming out, not just in the US, but abroad. And so I would just say that the regulation does not look like it is specifically applying to universities, but I would definitely track to the coming more specific regulations coming out from CARB, just to be safe. For 261, for SB 261, the regulation was specific that insurance companies are exempted from SB 261, and the reason for that is because a national standard was adopted in 2022 on specific climate financial risk reporting for insurers, and the California Insurance Board oversees that reporting already. So that is one type of company that was explicitly exempted from 261. Another one here: does meeting IFRS S1 and 2 requirements also mean compliance with SB 261? So the way that I would phrase that is that SB 261 is very specific, that meeting requirements, a company meeting requirements will mean that that company uses the IFRS standards, both S1, S2, or it also references that compliance can be met through the 2017 version of the TCFD framework. So to answer your question, yes, if you are using IFRS S1 and 2, or you plan to, that will be, just an excellent guide for you for meeting that regulation.
Bonnie, here's another one on the 5% threshold. Does it apply to only scopes 1, 2, and 3, or calculations using these values? So I would say the greenhouse gas inventory is the thing being assured, and it means, again, does the inventory correct within 95% of its total? So I think that's the answer to that.
Great. Here's a question asking whether to clarify whether science-based targets will be required under SB 253, or what other emission targets would be required under SB 253. So this is a really great question, because the SB 253 regulation does not have any requirements to set targets or to develop a transition plan, which I should say is a decarbonization transition plan. So to answer the question, no, SB 253 does not require that companies set a science-based target. However, for companies who have set a science-based target, that emissions inventory process that will be carried out annually would serve both the purpose for reporting under SB 253 and your process for tracking your emission reductions under your science-based target that you might already have or might be seeking to set in the near future. So it essentially, the data work that will be done for SB 253 will meet both purposes. And then there's just a note here on the proposed federal rule might be requiring a target and a transition plan. Yeah, so as we noted, really, if you're looking at a gap assessment, so to speak, between the SEC proposed climate rule and what we have now in California, specifically the combination of SB 253 and 261, you can see that target setting and transition process that is in the SEC rule is falling under SB 261. I would just note that we don't have a final SEC rule, and so we do need to kind of wait for that. But notably, companies are trying to prepare, and so I would just say what we have on hand under SB 261 and 253 provides a pretty clear path for companies to move forward. Let's see, could you please comment on any regulatory carve-outs for California compliance programs related to carbon? That's a really great question. And what I would say about that is because these laws are falling under CARB, obviously they will be, looking at setting process and regulatory rules, and we do anticipate that existing compliance programs that are related or relevant will be considered through that process. So I would just say let's keep an eye on what CARB's regulatory and program process development looks like in the coming year, and we'll have that final communication by January 1st, 2025, as per the regulation. Let's see. Will you be sharing a recording of this webinar? Yes, we will be sharing a recording of this webinar. That will be sent out in the coming days, along with a copy of the presentation slides. Does the disclosure under AB 1305 include all of the company's websites or only the corporate website? That's a really great question. I'll just say that the regulation is and I don't have it right in front of me, but it is specific that it is for the covered entity's internet website. So so it doesn't get into which or how many. Let's see.
There was a question about trying to find it here. About Vera.
Oh,
and
yeah.
Vera is a registry, so they issue the project category rules, and then verification bodies have to verify the that the project followed the rule and how many credits were available, and then name out all of the all of the parameters of those credit projects. So I would say that Vera wouldn't be reporting, but well, they do market. They are a registry.
They fall under the marketers and sellers. Yeah.
So they will have to, but the registries already have all of that information about projects. So I think it's getting back to the intent of the law, is that the credits that are used to do offsets or neutral claims are verified, legitimate, have all the parameters that make up a good carbon credit project. So I think that they will be involved.
Yeah, and there's a interesting related question here from one of the participants, noting that many carbon offset projects include calculations based on proprietary methods and processes. These could be under software models, very complex models. So will the disclosure requirements force essentially disclosure of proprietary information? That is very interesting, and I think is an area where this law, has some gray areas, maybe some expectations around litigation. What the regulation says is that data needs to be shared so that, to the extent that calculations and verification can be replicated. And so it does almost put the homework on actors in this space to seek to both meet the regulation, but also, answer that question. And honestly, it's not well spelled out, and it hasn't been tested yet. Let's see. Okay, will a company post its scope 1 and 2 to a specially designated CARB platform? So for SB 253, again, when we get those final regulations and rules January 1st, 2025 or before, it will entail the specific kind of reporting process, but it does specify in the regulation today that it does need to be reported to CARB. And there is also a filing fee that is not specified at this time in terms of the amount, and that is going to be a filing fee both for SB 253 and for SB 261. There's no reference for a filing fee related to AB 1305, and in fact, I didn't see in the regulation any requirement to specifically report the data to CARB. It really is around transparent communication on the company's website. Okay, I think that we have answered most of the questions. There is one here around AB 1305 and whether it's realistic that by January, information can be reported for 2023. The AB 1305 regulation isn't specific to what time period your reporting must entail, but it really is specific around just the transactions happening within the California market. So again, there's a little bit of vagueness there, but for companies that have a current carbon neutral net zero claim or are currently buying using offsets, the homework really is, if you are in this game, to gather the information and make it publicly available. Obviously, as reporting goes on over time, the information on the website would be updated. So we could expect, that 2023 information will be updated, but the specifics around when updates need to occur, I did not find that in the initial regulation.
Well, thank you, Bonnie.
Thank you, Karen, and thank you for so many of the participants for staying on as we kind of navigated answering all these wonderful questions. It was a pleasure to present with you today, Karen, and to cover this. Is obviously a lot happening in the California landscape and nationally and internationally as well. So we will seek to kind of continue these webinars as more information develops. And as you noted at the beginning of the webinar, I think the recording and the slides will be sent out in the next day or two. So after that, if you had questions that we did not answer, or if you want to reach out with any additional questions or support, we're here for you, and our information will be shared within that slide presentation. And here it is on this final slide.
Thank you.
Thanks.